Well, welcome everybody. Thank you all so much for joining us on today's edition of Self-Directed Saturday. So today we have Dr. Amir Baluch on with us, going to be talking about how to de-risk your IRA. My name is Colin Taylor. I am one of the certified IRA specialists with Quest. So to give a little bit of an introduction for Dr. Baluch, and speaking, he's going to be presenting more specifically on the Holy Grail investment theory, and I'll let him dive into what that all looks like. But Dr. Baluch is an investor, a serial entrepreneur, and a fund manager. He has over a decade of experience, specifically in private equity and securities, with a series 22 and 63. Amir is the founder of Baluch Capital, which is an alternative investment platform that focuses on generating outsized risk-adjusted returns and cash flow for accredited investors. Not only is he the founder of Baluch Capital, but he is actually an internationally best-selling author as well. He wrote his own book titled Make It, Keep It, New Age Wealth Strategies for Physicians. And he's also a regular contributor to Forbes. I'm sure a lot of you know Forbes magazine, right? He serves on the advisory board for multiple life science companies, aggregator entities, and consults for multiple clinics nationwide as well. Dr. Baluch actually got his degree in biochemistry from Trinity University. I believe that's there in San Antonio, Dr. Baluch, if I'm not mistaken, and obtained his medical degree from Texas Tech before finishing his anesthesia residency at the University of Miami. So everybody, as we go through the presentation, please put whatever questions you have for Dr. Baluch, and we'll bring him up here shortly. Please put whatever questions you have about the information, the topics being presented there in the chat. We'll get those questions up to him. Towards the end, we'll have some time for a little bit of question and answers. And then as we proceed as well, please understand that this is specifically for educational purposes. Quest does not provide any sort of tax, legal, investment, deal structuring advice. We're not here to endorse any kind of product or service. It is truly to kind of give you some information and hopefully expand your wealth of knowledge when it comes to alternative investments. So without further ado, let's go ahead and bring up Dr. Baluch here. Amir, thank you so much for joining us. It's a pleasure to have you on, and we're excited. I'm looking forward to the presentation.
Thanks, Colin. Thanks for having me on the show.
Absolutely. I'll bring your stuff up here and I'll just let you take it away.
Okay, cool. All right, guys. So my name's Amir Baluch, and I'm big on decreasing risk, and especially after the last couple of years in a couple asset classes, I had a lot of people ask me, how do I just take less risk? So I figure let's just talk about this not only at the portfolio level, but at the deal level. So we're going to de-risk your IRA or show you how to do that so you could retire on time or maybe even a little bit earlier. So what are we going to go over today? Some traditional investing issues, which is probably some of the reason you guys are trying to self-direct your IRA, right? So you guys would be pretty familiar with these. We're going to bust some myths because that's always fun. Then we're going to explain what the Holy Grail investment method is, and we're going to have a couple of case studies, and we're going to show also how to decrease risk at the deal level, not just the portfolio level. And a couple of bonuses at the end of the presentation for y'all. Another disclaimer, like Colin said, I'm not a CPA or attorney or financial advisor. And so this is just for educational purposes today. So this is for you if you're pretty busy and you're looking to diversify from traditional investments. You don't want to rely on the stock market for legacy, and you want to find some unique ways to get into different asset classes and decrease risk. A little bit about me. Colin mentioned that I am a contributor for Forbes. I have a securities license and a best-selling author, and really my goal is to just educate and give back now that I actually retired from anesthesia last year, actually, just following some of the advice I'm about to give you here in the next few minutes. We have combined probably approaching close to $1 billion of transactional volume that I've seen either as a partner, co-sponsor, or operator. And from that experience, we've kind of come up with some math that makes a lot of sense. But it didn't start this way. So let me tell you how I kind of came into this world. So you can see in the top left corner, that's me. I was a pretty big nerd. In fact, people say this is the worst picture they've seen of anybody ever. So I've been told that a few times. But I think that actually just made me focus more on my work. So you can see in the second picture with me with my calculus book, I was able to place out of calculus at the end of the 10th grade, like two college classes were kind of done. And that was my favorite class, thanks to a very good math teacher that I had that helped me on weekends study math because I was a nerd and I didn't know what else to do on weekends. But then before I went to medical school, something really somewhat tragic happened. So my dad, who's a doctor, internal medicine, he declared bankruptcy because he didn't have financial education like you guys are getting now. He didn't have any mentors. He didn't diversify his assets. And also the only way he was making money was by being a doctor. And when a couple bad things happened, one investment after another, he wasn't able to pay the bills for his clinic, had to declare bankruptcy, and we moved to a 1-bedroom apartment for about $250 a month. And if you know what $250 gets you these days, that's not that great of an apartment. So as I was looking at the ceiling fan, thinking, what am I going to do with my life? Because that same year I got rejected by medical school. So I was really, that was a really tough year in 2000. I was thinking, I better learn how to diversify my skill set and what I invest in the future. And so I started reading a lot of books and going to seminars, and that was about 25 years ago. So this whole thing's been about a quarter century in the making. But eventually I did go to medical school. As you can see all these white coats here, and eventually became an anesthesiologist after training in Miami. And as soon as I came to Dallas in 2010, I figured out pretty quickly, I don't want to learn the way most other doctors learn about investing, which is from each other in the doctor's lounge or off the internet. So I got my securities license at that point and joined a boutique investment bank called Nobles and Richards, and they had a broker-dealer arm. So I was a registered rep in a broker-dealer. Was a broker-dealer. They're people that buy and sell securities, and basically a lot of the things that you're investing in, if you're a passive investor and there's a pooling of money to passively invest, that by definition is a security. So I figured, let me just learn from people that are in the business of this, right? And luckily, based on a lot of mentorship that they've given me, as well as a lot of my other mentors, I was able to generate a lot of passive income and had the option to retire from medicine last year or go very semi part-time right now. And now I just spend time with my friends. I travel a little bit here. You can see me running with the bulls. This picture actually made the front page of the Pamplona, Spain newspaper later on that day. And if you want another story for another time, you can reach out to me. I'll explain how one time I did get semi-run over by a bull. So we could talk about that and how I survived. This trip to Italy was a lot better. Before I wasn't able to just take 2 weeks off until I was able to get some more passive income with better investments. And now we give back to a lot of people locally in Dallas. We're big on the North Texas Food Bank here, and also affordable housing are two things we like to focus on. And this last picture doesn't have my book in the picture, got kind of cut off, but we try to educate with books and educational seminars like this. And it's been working for a lot of people. You guys can look me up on LinkedIn, and there's a few other testimonials from people that I've helped out over the years. So let's talk about why traditional investments have failed, and probably why you guys are looking into self-directing your IRA, right? So if you're not familiar with the 60-40 rule of investing, which was pretty popular in the 70s and 80s, basically an advisor / financial salesman would probably tell you, hey, just invest 60% in stocks, 40% in bonds. And that may have worked for some people in the past, but we live in different times right now in 2024. We have a global marketplace, and there's not as much diversity in the stock market. And if you look in this article here, which by the way, this is just from Investopedia, but anywhere you look online, it's saying the same thing. Basically, this is a time for alternative investments. What does that mean? Just something that's not traditional like stocks and bonds. So it could be private equity, could be real estate, could be hedge funds, could be precious metals even, could be promissory notes, a lot of different things. And what some people smarter than me and people that are managing billions of dollars, like right here, Bill Rice on this Investopedia link, they're projecting that if people stayed with the traditional way of investing, you're probably going to grow 2.2% annual return over the next 10 years after you adjust for inflation. So that's not really moving the needle, which means you're going to retire later if you continue with that strategy. And so I think more people at least want to have the option to retire. So we need to move away from this. Now let's bust a couple myths before we talk about how to accomplish all this. So there's this idea that the public stock market is such a huge market, and there are trillions of dollars in that market, right? But 87% of companies that are doing 100 million of revenue plus are actually private. There's a lot more private deals and private businesses you could invest in. So at the end of the day, we're pretty much investing in businesses. There's public and private equities just meaning businesses, right? So it makes sense. Why would, if somebody wants to truly have diversity in the market, and most of the market is private, why would you have everything just in public securities? So from a diversity point of view, that really doesn't make a lot of sense, right? So that's one myth we're going to bust. You can share that with your friends and teach them something new. Here's some more myth busting. A lot of people believe that just investing in the S&P forever and ever and ever, everything will be okay. Well, not only is that not true, most likely not going to be true in the future, but it wasn't even true in the past. So if you look at any segment of year, 5, 10, 15, 20, even 35 years, private equity has outperformed public markets in every segment that you look at. And now let's look at another a private space, private debt, where instead of comparing to public stock market, we're comparing it to something like bonds or T-bills. But private debt has actually outperformed other forms of debt that are traditional, such as bonds. So it looks like private debt in the past and projected in the future is going to outperform. So now we have that performance side taken care of. Let's look at some people that are way smarter than me when it comes, and they have even a lot of resources, billions of dollars of resources to allocate for the best portfolio managers, the best investment advisors out there. Let's look at Harvard and Yale's endowments. So if you look up here, it's kind of hard to see in the top corner, this kind of aqua color thing. Harvard has about 10.5% in domestic equity, which for the most part means the public stock market. And Yale is pretty much the same. This kind of purple section right here is 11%. So the smartest asset allocators have about 1/10 of the portfolio in the public markets. That's pretty different from the 60% that's suggested by some financial advisors and the old school way of thinking. Also, I don't have a slide on this. I should have made one, but high net worth groups such as Tiger 21, for example, they have similar type of model as well. And in both of these charts, more than half the portfolio is actually in private assets. So unfortunately, when you look at the average investor, they only have 3% in alternative markets or in private equity. They have 97% in traditional investments. And that's mainly because a lack of access, high minimums, and some interesting investment structures that haven't been explained to people. So now let's get to the good stuff, the Holy Grail portfolio strategy, and how you could use this today to decrease your risk. And why do I always talk about risk? Well, it's easier, believe it or not, to decrease risk versus trying to find some type of deal that will give you 2-3 times the return that you're looking for. And at the end of the day, we want a good reward to risk ratio, right? So for every one, let's say if we have a benchmark, let's say S&P 500, you take 1 unit of risk in order to get 1 unit of return. So X amount of risk, And let's say stock market does 8% return. Okay, there's your return for 1 unit of risk, right? But what Harry Markowitz won the Nobel Prize for in 1990 is to show that you could actually reduce your risk by 80% and get same or possibly even higher returns. So if you decrease your risk by 80%, you're taking 1/5 the risk, but getting the same or higher returns, you're basically getting 5 times the return on every unit of risk that you're taking. And he's not the only one that thinks this is important. Ray Dalio, who's one of the top 5 most successful hedge fund managers in the world, he talks a lot about this in his book called Principles, which I totally suggest everybody should read, or at least skim through it and look at some summaries or something like that. But he uses this himself. So I just do what the other smart people do. I'm not trying to deviate from that, right? And so this is kind of what we're doing. If you look at this chart, there's on the left side, there's reward going up, and on the right side, there's risk going up, which a lot of times is measured as volatility, right? So if you decrease volatility, you decrease the chance of catching yourself in a low. That's decreasing risk. So if you go up and to the right, you've increased your return. If you go to the left, you're decreasing risk. So if you do both at the same time, where it says goal, now you have high returns, but taking 1/5 the risk, or 1/3, 1/2, depending on how diversified you are. So that's what we're trying to do. And what does correlation mean? Because what they mentioned when he won the Nobel Prize, these asset classes had to be non-correlated. So one example is, let's say stock market is going up. This is an old example, but a lot of times when the stock market is up, the bonds kind of go down. They're somewhat not correlated, which is why they made the 60-40 rule back in the, decades ago or half a century ago. But you can do better than that, because sometimes there are certain variables that affect even those two assets. And we saw this back in 2022, right? So non-correlated assets, let's say you have private real estate, you have S&P 500, you have crypto, you have precious metals, you have arbitrage plays, there's even litigation finance. There's so many asset classes, and they all go to the beat of their own drum. And when you take a summary of all these squiggly lines, you actually get a straighter line in your portfolio. Because if one thing is dipping because of certain variables, so for example, let's take interest rates, right? Everybody is focused on interest rates these days. Well, if interest rates go up and up and up, what does that do to some commercial real estate things? Well, it probably decreases the value. But as interest rates goes up, there are other asset classes, like what if you were a lender? You could probably charge a higher interest rate. So if you're in a lending fund, or if you invested in promissory notes, you're probably getting higher returns when interest rates are going up, right? So that's just a very small example of non-correlated assets, and they don't always have to go opposite of each other. For example, let's say if you're trading in the Indian stock market compared to the U.S. market, it's not as correlated. There's about 70% correlation, but you are getting at least like that 0.3 diversity in your portfolio just by going into another geographical area, right? Which runs off of different variables. So that's correlation ratios. And I think I told you before, I really like math. I'm even doing it on weekends, right, for fun, if you can believe that. So I just put together this quick little chart. Just, if you look on the right side, actually, usually people say, oh, get small cap, mid cap, large cap. You're diversified, right? Well, not really, because all those things have pretty close to a correlation ratio of 1, which means when one goes up, they all go up. When one goes down, they all go down. On the left side, if you have 6, 7, 8 different asset classes, could be gold, private real estate, crypto, S&P, whatever you want. When these assets are not correlated, you actually can decrease your risk to 0.2, which is 1/5 of 1, right? Which is why we say we could decrease volatility and risk by 80% and still get similar, or as a lot of you guys already know, if you're self-directing your IRA, you're probably making double-digit returns, right, in alternative assets. So you can actually make higher returns with alternatives that are non-correlated. But it's not that easy, right? It's very difficult because there's so many choices. There's hundreds of different investments you could have. How do you determine performance? How do you know if they're correlated or not? Most people don't even talk about this. So they just talk about the returns. Hey, what's your IRR, right? That's what everybody talks about. But that's only important in context to the risk. And so, if there's anything somebody could walk away with this presentation, is just start asking more about risk, because if you become a professional at understanding risk, you're going to do really well. The upside pretty much takes care of itself. And if for some reason it's hard to assess it, you guys will have my contact information later. I don't mind spending, a little bit of time on the weekends to help you guys out and look at something like that. So let's take an example of a holy grail pie chart. And I just created these non-correlated asset classes on the right, just as an example, right? But each one of these categories has its own sub-asset classes. So for example, private equity could be venture capital, could be growth equity, could be leveraged buyouts, could be a small business down the street from you. It could be a lot of things. Private debt could be hard money lending, could be arbitrage lending, could be factoring, right? So there's all these subclasses. But in general, these categories are not as correlated with each other as the traditional way of doing 60-40, right? So that's kind of what we want to do. And the cool thing is, once you learn this, you can make your own portfolio and determine where you want to allocate your risk-reward ratios to. So here's an example. This was a doctor that approached me who is pretty much 100% in the market, and they kind of got burned in 2022. I don't know how much of their net worth they lost, but it's pretty significant. And he was investing from a self-directed IRA, but also outside the IRA. He's like, Amir, I need some cash flow. I'm kind of getting burned out of medicine. I would like to just take every Friday off or every other Friday off, have a 3-day weekend. That was his goal. So we try to get him to his goal. So his portfolio is going to be different from you, but what we helped him do here is we had a fixed income product for him that was a double-digit preferred return that pays monthly. So he wanted that. And then a public equities trading fund called Prosperity Pulse. He has that for quarterly cash flow. He did want some real estate exposure into private real estate, but didn't want the traditional LP-GP structure. So he came in on the debt side. So it was private debt and private real estate combined into one thing. So you could do that too. High tax bracket for a lot of physicians. So we had him in an equipment sale leaseback fund where he could depreciate all the equipment in year one against his taxes and then get double-digit preferred note after that for leasing it out. Life settlements kind of goes at its own pace. If you guys aren't familiar, that's where you could buy other people's life insurance policies for 15 cents on the dollar and become the beneficiary. So that's an asset class not easy to get into, but we got him in there. And then he wanted a pre-IPO strategy to invest in private companies, but just at the tail end before they go public so he could cash out. So a lot of the IRA investing was done in these illiquid investments, these last two, E and F, because your IRA is illiquid, right? So it makes sense. And so what's our approach when reducing risk, and how you guys can follow what we're doing yourselves even? So, a lot of times we can actually create the access because we have a lot of investors that back us. So we can usually negotiate better terms for everybody. But you could even create your own. Like if you wanted to go to an asset class, you could partner up with some of the smartest people in the space and see where you could fit in. But our approach is we try to create that for people. And we have very strict underwriting when we look at these things. We'll show you our team a little bit. And we always have transparency in investing and relationships first approach. Same when we look at a deal, we want them to be transparent. So they need to be able to show us their track record. If they have an audit, that's better. We want to get some references, things like that. So you could use those same approach. And when sourcing deals, we don't always want to look online or whatever our friend from high school is doing. We don't want to necessarily just jump on that. So we have a systematic approach. This is ours. You could have your own systematic approach. but we network a lot in the security space, broker-dealer network or other networks. And these people already are getting pre-vetted deals sent to them. And if they know what I'm looking for, they send me over some things and we share back and forth. I'm also fortunate to be in a lot of private equity masterminds, so I get a lot of deal flow like that. And I offer consulting for private equity firms. And so we just share each other's network. And whenever there's something that looks like a good project, we try to tag team into that. Now, how do you reduce risk at the deal level? We talked about portfolio and how to get some deals. Now you got a deal. What should you be looking for? Well, you want to see that people, if it is a sponsor or an operator, do they have some skin in the game with co-investments? How are they doing their research and analysis? Like, how do they even know it's a good deal? Or are they just trying to get a finder's fee? So we have an in-house team here with a senior analyst with Goldman Sachs, who's our CFO. We have bookkeeping and accounting done with people that have worked at Deloitte, KPMG, any real estate analysis done with senior analysts through CBRE. And for specific asset classes, there's just examples of names down here. So like, for example, Yuri down here, he's basically one of the top people in a $12 billion emerging markets fund out of Europe. So he looks at the whole world and where it makes sense to invest. So if we're going to do emerging markets, we're going to talk to him and bring him on board. Baker has traded $300 million of George Soros's money. He's another famous hedge fund manager. He's been doing that for more than 30 years. I'm going to get his opinion before we go into something like that, whether it's Forex and actually he does emerging markets too. Tice is really good at precious metals. Any King is one of the first fund managers in the crypto space since 2011, and he's won awards for being top performing fund manager in that space. And it goes on and on. We could, triple the list of people that we talk to here. But you guys can kind of do the same thing. If something comes to you, you can go out there and find an expert to help you decrease the risk at an operational level, right? Not just, hey, let's look at some numbers, let's look at track record, but operationally, where are the risks? So here's some examples of projects that we have put together. Most of these are already closed for investments, but we could use them as case studies. So about 2 years ago, we put together this an investment called Nobility Lending, where we're lending to e-commerce sellers on Amazon that are looking for growth capital. So why was this cool? Well, we know interest rates are going to go up, and if interest rate goes up, we can actually charge more too. So we're inversely correlated with all the other assets that go down in value when interest rates comes up. So this was a huge hit, and our approach was unique because we have an in-house team that can underwrite the actual products being sold. We don't even need to underwrite the person borrowing. So if you guys are familiar with hard money lending, which you probably are, because a lot of you guys I know invest in real estate, imagine hard money lending on e-commerce products. Last time I checked, there's only 16 other people doing it in the nation. And our unique approach, because it's an arbitrage market neutral approach to lending, we were featured in TD Ameritrade and Business Insider. What about real estate? I know a lot of you guys love real estate. And when you look at the deal, you might want to ask yourself, okay, why is this lower risk? Forget about the returns, right? Projected returns are almost always, 10, 20%, whatever the number is today, right? But most of the time, how is the deal de-risked or lower risk? A lot of times it's because there's a volume discount, right? Or there's a price discount. So if you could look at an appraisal and say, okay, this thing is 10 million and you got it for 8, all right, you already have a buffer to prevent you from risk. Then at the deal level, this is an example from one of our deals, which is already closed, but based on our comps, we were going to sell at the same price, but we have 33% larger lot. You guys are from Texas, we like our land. So this is going to be pretty appealing to people. Or, and another one here we're doing in central Dallas. These are, some townhomes we're developing right now. You can see the picture with rooftop decks with downtown views. Well, there's nobody in the area with downtown views in brand new townhomes. There's not a lot of place to build. There's already houses there. So there's no competing areas. And where you already have comps that have come out that let us know what the number should be, even if there's no appreciation in the next 2-3 years. So all these things are helping decrease our risk on the operational side, because part of that is selling, right? So we decrease our risk of sitting on the market because we have a unique product that nobody has in the central Dallas market. We also have other options. What if it doesn't sell, right? Because plan A is to sell. Does the operator have plan B, C, and D lined up? So for us, refinancing and cashing out and moving to rentals, build to rent, short-term rentals, we can do that in a lot of our areas. That's our way of reducing risk. Some other people might have some other ways, right? They might already have the exit buyer ready to go. They could be doing build to suit. They have people that want a certain amount of homes built for them. Some other people have builders ready to buy the lot once the land is developed. So some people just develop the land and they have the exit buyer there. So all these different things, you want to look into that. My favorite way of diversifying from the public markets, this just recently we put together a hedge fund that trades in the Indian stock market. It's market neutral strategy, correlation of 0.7 compared to the US stock market. So I like this a lot. Plus, it's liquid. So if you guys have invested in alternatives like real estate, you guys probably already know is pretty illiquid, right? And some people complain about that. Even I've complained about that, but now we have a solution. We have something that's liquid. So strategy is very complex. I'm not going to talk about it here, but it's very market neutral. So it doesn't matter if the market goes up and down, and it's also less competitive, and it's not correlated with the US stock market as much as other options. So at the deal level, we've decreased a public markets investment opportunity. So if you put all this together, you'll have more of a straight line in your portfolio, anywhere from 12 to 30% annualized return, depending on which asset class you're in and things like that. And the most important thing is a little bit more stable and a little bit more recession resistant. Another thing you should ask too is, how does it work after somebody invests? You want to see that they have third-party administrators. It's nice that they have some investment portal. They have third-party audits. So for example, I have a company that runs securities compliance for me. We're mandatorily do third-party audits. You want to look for something like that. We at least have two people that have to authorize every wire, a third party and somebody on my team. And we want to make sure that people are accessible by phone call, text, or email. So, I know there's some investments on the internet. There's not even an email to reach out or an office, right? So there's some basic things you want to look at, a little bit right before you make an investment. And that'll decrease your risk too. So if you guys find this helpful, or if you want to contact me, you could join our Wealth Circle. It's usually a private membership that's $1,000 a year to join, where we share in deal flows, we share in education, we have private seminars and private events. So if that sounds like something that's cool, you could click on one of these QR codes I'm about to show you. Or if you want to just speak directly and just hop on a 10-minute call or something like that and see where you're at, see if we could help you. And if we're not a good fit, we can also point you in the right direction. So we have a lot of resources, and we share whatever people that we have in our network to help you get to your goals, which is definitely unique and customized based on your priorities. Some other free things too. You're going to get a link to my up and coming book called Prosperity Prescription. It's not out yet. It's probably going to be out in about a month. We also have a financial success planner, so you can actually put your goals to paper and actually start making a plan that makes sense. A lot of people don't like to pay taxes. Here's a list of top 20 tax deductions that a lot of people miss. This might be just some free money for you right here if you grab this. A guide on work-life balance. I know a lot of my physicians feel they don't have that right now, and I don't blame them. You might feel that too, depending on what field you're in. So we have something to help with that. If you want to do a complimentary second look at what your portfolio looks like, somebody on my team can do that for you. And just a membership card. Just know that you're a member of our Wealth Circle. A couple of QR codes here. Free gifts on the left, quick chat on the right, and you can find me on LinkedIn, Instagram. If you like cool looking reels and stuff like that, we do have some cool videos we put out on the Instagram. Definitely more professional on the LinkedIn side though. So either way, you can get a hold of me. And if you got any questions, we probably open up for people.
Yes. Okay. Perfect. Well, Amir, thank you so much. That was incredibly informative. And we haven't had any questions come through just yet, but I've got a few announcements for the Quest side of things as well. And everyone, while I'm going through those, please stick around for the Q&A and put your questions in the chat in the meantime, and we'll get to those here in just a moment. So talking specifically about self-directed IRAs, for those of you who are new to our education platform, maybe this is the first time or one of a few times that you've attended a Quest event or an online webinar, we would be more than happy to, kind of give you more information on our services and self-directed investments as well, and how you can potentially use something like this to invest in Amir and what they offer, and all kinds of alternative assets, right? And specifically being able to take some of your money out of the stock market and diversify it a little bit. So that's really the key with alternatives. There's just a list of a few different options and asset choices that people have when using a self-directed custodian specifically. So if you do have some more questions about that, please let us know. I'll post my email address and the Quest contact information in the chat as well. You can go to our website in addition to that and be able to find information there. The IRA Specialist email address, whether you're speaking to myself, one of my colleagues, we're all very happy to help. There's a QR code you can scan here as well if you are interested in a completely free consultation just to assess, fit, discuss custodial services, all of that stuff, and kind of tailor what you can do in these accounts. The last announcement that I have here for y'all as well is about the Quest Expo. If y'all have not heard of the Expo, this is one of the largest alternative investment conferences that's going to be happening, especially in Texas, but really in the country. And we have speakers and experts coming in from all over and going to be giving different keynote presentations, and we'll have panels and Q&A sessions and a ton of networking for you to get information or potential resources on whatever kind of alternative assets or self-directed, issues that you have interest in or concerns. And this is for, I would say, people, regardless of your experience level, regardless of your investment interests, there really is something for you there at the Expo. And we also have a video that we are going to pull up now and play that for y'all, just to give you a little bit of an idea of what the Expo will be like. So, Mac, if we can get that up here.
Right here, right now.
So we are here because we want to meet as many investors as we possibly can. Quest does a great job at putting people here at the event. This event, I think, is great for first-time borrowers, first-time investors, and experienced investors. This event is great for finding funds that could fit their investment needs. I get a lot of business from the Quest event. I talk to people, I network with people, and it actually becomes business after the event.
All right, perfect. And Ashlyn asked the question, I guess towards Amir, are you going to be at the Expo next month? I think that's a conversation you and I might have to have after this and look at some potential opportunities. I think, it'd be great to have you come speak on there as well. So, yes, hopefully, Ashlyn, the answer will be yes. And Amir, certainly you and I can discuss that maybe this upcoming week if that would be of interest.
Okay.
So that is about all I have for our announcements. And I'm going to throw your information back up here as well. So JC asked, where do you see interest rates going?
So that's a good question. So remember I talked about how so many variables affect different asset classes going up and down. So we don't really know where it's going to be, but I think it's more important to understand what's making interest rates go up and down. And it's also important to keep in mind that we're actually at a relatively low interest level if you look at the last 60, 80 years. So I remember in the 80s, we had some double-digit interest rates, and the whole goal of increasing the interest rates is to kind of slow down inflation. So why do we have so much inflation? Well, we printed about 80% of the money in circulation since COVID. That's like 4 times increase in the money circulating. And that's just money. So now you take that money and you put it into banks, and banks are going to lend out 8 times that money, right? So the amount of dollars as well as credit has gone up through the roof, which kind of created a little bit of an artificial boom during COVID. And that has to be pulled back so we don't devalue the dollar that much. So those are some variables saying, yeah, we really need to slow down the interest rates, or we really need to increase the interest rates to slow down inflation. Now, why do I think that it's not going to go up that high? 'Cause if it does go up, it's not going to be that much. And the reason is, traditionally in election years like we have, I think a lot of people get together and say, hey, what's good for my campaign? Let's show that the economy is going strong, and let's take this interest rate down a quarter point and get some people to vote for me because now the economy looks great, right? And we don't want to scare people too much, because if we scare people with an increase in interest rates, that fear has negative effect on the public stock market, which has a negative effect on the U.S. economy in general, right? So they don't want to do too much fear. So it's a tug of war with all these different variables. Everybody has different reasons for doing what they want to do. But in the long run, let's say if we increase interest rates now, okay, great, we're going to correct that hyperinflation that we had and slow things down a little bit. If we don't do it quickly, it's going to be spread out over the years. So do we want to pull the Band-Aid off really quick and go into a large recession, or do we want to try to spread this out to have a soft landing? So I think whatever the changes are going to be, it's going to be within maybe half a percent throughout the rest of the year, maybe 0.75 at most. Because if you go further than that on either side, you're going to disrupt some people's livelihoods one way or another. So that's what I think about interest rates.
Perfect. Yes, very well said. So, Amir, before we wrap everything up here, and obviously, your links there for some free resources and how to get in touch with you. Do you have anything else to add? Specifically for investors, people who are interested in getting more information from you, people who would, consider hopefully investing with you, any opportunities or specific things that you'd like to speak in that regard to?
Well, what we like to do is just understand what people's priorities are. And so we usually start with a discovery call and see what they've invested in, what's worked, what hasn't worked. And then, out of all the opportunities that we have, we try to narrow it down for them. Trending, though, I've seen a lot of people wanting to find higher cash flow investments. So we've actually refocused ourselves to find asset classes that have higher cash flow than a regular, 2 to 4% dividend from a stock, maybe a 6% pref from a multifamily, right? So we're finding things that cash flow at double digits so people can buy their time back. And so that's kind of how we've been positioned. So our latest fund, our Indian trading fund, is doing that. So people can get quarterly payments, and also our lending opportunities, whether it's e-commerce space or promissory notes, has been pretty popular because of that too. Those are just like 2 or 3 off the top of my head that I know are becoming more popular because people are focusing more on cash flow these days than just growing a huge nest egg and then dying, basically. Yeah. So,
absolutely.
Yeah.
Okay. Wonderful. Well, I think that's about all the questions we have. So, we'll go ahead and close it out there. Again, Dr. Baluch, thank you so much for joining us today, for coming on our platform and being able to speak a little bit more about diversification and how you can diversify your portfolio, mitigating risk, and all of these topics. I mean, it's incredibly valuable. So everyone, please, go harass him, ask questions. He's there as a resource too. So we appreciate your time, Amir.
No problem. Thanks for having me on the show.
Absolutely. And everybody else, enjoy the rest of your weekend, and we hope to see you next time. Y'all take care.